revenue recognition, the whole goal of this ASU was to take the US GAAP that we follow and mirror or merge it into international accounting. So how is revenue recognized on an international basis through IFRS? This standard is being passed through for most nonprofit companies. This will come into play in 2019. So we've got a few years. And positive news, a lot of your revenue won't have to change out of this. So I have this in here again. I think this will impact your grantees a lot more than it will yourselves, but we'll walk through the areas where it might impact foundations as well. Think of all the revenue and how you get revenue into your foundation. The first most common, investment income. You can see the third item on this list that is excluded, financial instruments. So how you're recognizing investment income, no change. Second piece that most foundations as to how they get revenue, contributions. You can see at the very bottom, excluded contributions. So right, good news. This isn't going to impact you too much in those worlds, but then you think of, well, what other revenue streams could foundations have? The next thing I think of is potentially some government funding. Of course, FASB yet hasn't concluded how that's going to fit, so it's not excluded, it's still being discussed as to how those transactions will be treated, so that one's kind of the to be determined. Another potential revenue stream you might have is lease agreements, where you have other organizations leasing a component of your space. Top item here, leases, they're excluded. So it won't have too much of an impact on your organizations, but I think the bigger piece will again lie with your grantees. So here's an example of what this actually means, considering I just excluded all of your revenue. Think of a zoo. You pay $100 a year to be a member at a zoo. In the past, that zoo would take that $100 membership, and let's just say this zoo is a calendar year entity. 2016, 12/31/2016 is their year end. That $100, if I pay it in January, they're going to take that $100 and recognize it evenly over 12 months, right? Because their service to me is by being open, being a zoo, I can go there. So once each month passes, they can basically recognize that revenue. What the new standard says is now me as the zoo, I have these $100 memberships, I need to analyze that membership and say, what other benefits or what other obligations are in basically this contract, this membership agreement? What other obligations do I as the zoo have to provide to my members to basically earn that $100? So a couple examples. If I'm a zoo and I just determine that that $100 membership, really only 80 of it, on average, we've done a lot of research, about $80 covers what one person would typically come to the zoo and see over the cost of admissions fees. So that other $20, we're considering it a flat-out contribution. So now, if I'm the zoo, I get that $100 in January, 20 of it I can recognize right now, because that contribution isn't related to me doing anything for them. And now I'll take that other $80 and I'll amortize it over 12 months. Let's also say that out of that $100, new example, $100 membership fee, but let's say $20 of it I've set aside because as a perk to your membership, you get to come to one exhibit opening throughout the year. We kind of have an early allotment for members. You can come to the exhibit in advance and see it. So you come into that exhibit because of we bring in food, we bring in drinks, we make it kind of more of a show. We're going to say $20 of that fee is going to cover that exhibit. So now, if I'm the zoo, I'll take my $100 I got in cash, $80 of it I'm still going to recognize evenly over 12 months. That last $20 that relates to basically someone coming to an exhibit will sit as deferred until someone actually comes to an exhibit. So until you actually then meet your obligation as it sits in that contract, then that's when you'll recognize the revenue. Steve?
What happens if the membership is not refundable? Recognize the income right away?
Yep, exactly. So as we walk through these, so there's the 5 steps to that, so that'll get captured in there. Number 1, if you're nonprofits, or if you do have revenue streams outside of the ones I excluded for foundations, number 1, identify your contracts. Number 2, for each of those contracts, identify what performance obligations you have. So what do I need to do to basically earn that revenue? 3, determine the price. 4, take that price and allocate it to all those performance obligations. And then 5, recognize the revenue when we've satisfied that obligation. So if me satisfying the obligation is simply cash collection, because I've never given them a penny back, even if they quit their membership or whatever, you've met your obligation. So there can be those caveats to it, but it's more of, here's the contract, what's kind of unwritten in that contract? What do I need to provide to the individual or to the customer to actually recognize that revenue? Why you might care. Again, your grantees will have this. A lot of this is initially going to fall into disclosures. Just like everything else, when we can't make it fit on the front page, we'll add some notes. Your grantees, you might see, if you grant to the same type of organizations, they might recognize revenue differently based on these underlying contracts. You may not have 100% apples to apples comparison anymore. In theory, over 12 months, I would think they'd get pretty close, but you may have some differences. Those will be disclosed in the footnotes. So footnotes right now have about this much disclosing revenue recognition. That in theory is going to get much bigger as you discuss, or your grantees discuss, the different ways that they recognize revenue.